most principals make the same structural error. They relocate to a low-tax jurisdiction, the UAE, Hong Kong, Singapore, receive their residency certificate, and consider the planning exercise complete. It is not complete. What they have done is finish the first step of a far more consequential process. A residency change is not a platform, it is a threshold. What matters, what determines whether that threshold provides durable legal and tax protection under current enforcement frameworks, is the architecture you build once you cross it. This episode is about that architecture. Specifically, it is a direct comparison of the two dominant inbound holding platforms available to high net worth principals in 2026, the UAE Free Zone model and the Hong Kong territorial model. These are not equivalent alternatives. They serve different capital geographies, carry different legislative risk profiles, and respond differently to the OECD's post-BEPS enforcement environment. Understanding the distinction is not an academic exercise. It is a prerequisite for any structure built to last. Let us begin with the regulatory environment that now governs both platforms. The OECD's BEPS Action 5 framework, the standard for countering harmful tax practices, establishes a core principle. Income booked in a jurisdiction must be supported by genuine economic activity in that same jurisdiction. This is not a soft guideline. It is the architectural constraint within which every modern holding structure must be designed. The UAE operationalizes this through Federal Decree Law number 47 of 2022. Under this framework, a free zone person seeking to access the 0% corporate tax rate on qualifying income must demonstrate physical presence, local management, and proportionate operating expenditure within the free zone. The Federal Tax Authority has published detailed guidance on what constitutes adequate substance, and that guidance is enforced. The annual cost of maintaining credible substance in a UAE free zone ranges from approximately $18,000 at the lower end, a basic flexi-desk arrangement with minimal staff, to $42,000 or more for a structure that can withstand granular FTA scrutiny against the 0% corporate tax rate. On qualifying income, the arithmetic remains strongly positive. But principals must understand they are not simply purchasing a visa, they are purchasing substance credibility, and substance credibility has an ongoing operational cost. With the regulatory baseline established, we can now compare the two platforms on the dimensions that determine fit. Hong Kong operates on a territorial source principle. Under the Inland Revenue Ordinance, only income that arises in or derives from Hong Kong is subject to profits tax at the standard rate of 16.5%. Income derived from business conducted entirely outside Hong Kong is, by statute, outside the charge to tax. This has historically made Hong Kong an exceptionally clean platform for principals whose income-generating activities are conducted in third jurisdictions. However, the 2023 introduction foreign-sourced income exemption regime expanded again in 2024 and further refined under the 2026 Inland Revenue Amendment Ordinance has materially altered this picture. Specified foreign-sourced passive income, including dividends, interest, intellectual property income, and disposal gains on shares, is now subject to a nexus test. If the holding entity cannot demonstrate adequate economic substance in Hong Kong relative to the income received, that income falls back into the charge to tax. The UAE's approach is structurally different. It is not a territorial system. It is a federal corporate tax system with a carve-out for free zone persons who meet qualifying income and substance requirements. The distinction matters. The default in the UAE is that income is taxable at 9%. The 0% rate is a conditional exemption that must be actively maintained, not a baseline that applies by statute. On Treaty Network, the comparison is straightforward in scale, but nuanced in utility. The UAE maintains more than 140 double taxation agreements, one of the broadest networks globally. This is particularly valuable for principals with outbound investment into high-tax treaty partners such as Germany, India, or the United Kingdom, where withholding tax rates on dividends and royalties can be reduced substantially under treaty. Hong Kong's network is narrower in absolute terms, approximately 50 comprehensive agreements, but provides a utility the UAE cannot replicate: direct structural access to mainland China through the BEPS framework and the associated DTA protocols. For any principal with material China-sourced income or China-domiciled operating companies, this asymmetry is decisive. The correct selection logic is not which jurisdiction has a lower tax rate. It is which jurisdiction's treaty network maps most efficiently onto my actual cash flow geography. That is an empirical question, and it requires a capital map, a documented analysis of where income originates, where it flows, and where it is ultimately consumed, before we proceed to structural architecture. There is a constraint that invalidates much of the conventional offshore planning literature, in which most advisors are still underweighting in their client conversations. The OECD's Pillar 2 framework establishes a global minimum effective tax rate of 15% for multinational enterprise groups with annual consolidated revenues exceeding $750 million. For groups above that threshold, a top-up tax applies at the parent jurisdiction level to any constituent entity that generates an effective tax rate below 15% in a given jurisdiction. What this means in practice: a UAE Free Zone entity generating zero-rated income held within a qualifying M&E group is now subject to top-up taxation, either through the qualifying domestic minimum top-up tax in the UAE or through an income inclusion rule charge in the parent jurisdiction. The era of binary tax planning, high tax versus zero tax, is structurally over for in-scope groups. For principals below the €750 million threshold, Pillar 2 does not apply directly, but the legislative architecture it has created, the QDMTT framework, the STTR provisions, the UTPR backstop, represents a permanent recalibration of the enforcement environment within which all structures must now operate. With the regulatory and comparative framework established, we turn to architecture. What does a defensible inbound holding platform actually look like in 2026? The first architectural principle is entity separation. The instinct among principals, particularly those transitioning from simpler offshore arrangements, is to consolidate assets within a single holding entity. One free zone company, one bank account. Clean and simple. That simplicity is a liability. When a tax authority, whether the FTA in the UAE, the IID in Hong Kong, or a foreign authority operating under a CRS information exchange request, commences an audit of a single entity structure, it gains simultaneous and unrestricted visibility into every asset class within that entity: intellectual property, listed equities, private equity stakes, real estate holdings. The preferred architecture for principals with diversified asset bases separates intellectual property from financial assets across distinct free zone entities. Each entity maintains its own substance record, its own banking relationship, and its own treaty position. The operational overhead is measurable, roughly double the single entity cost. The reduction in correlated audit exposure is structural. Under this IP/holding split model, Free Zone Entity A holds patents, trademarks, proprietary software, and any royalty-generating intangibles. It maintains substance specifically calibrated to the BEPS Action 5 Nexus requirements for IP income documentation of development activity, modification records, and exploitation history within the jurisdiction. Free Zone Entity B holds financial assets, listed securities, fund interests, private equity co-investments, and cash. Its substance requirements are lighter but must demonstrate genuine management and control of the investment portfolio. The second architectural principle concerns the ownership layer above the free zone entities. Nominee holding arrangements, where a third party holds legal title to shares or assets on behalf of a beneficial owner, were designed for a pre-AEOI enforcement environment. Under the Common Reporting Standard, now active across more than 120 participating jurisdictions, Beneficial ownership transparency is automatic, not discretionary. Financial institutions in CRS jurisdictions are legally required to identify and report the underlying beneficial owner of every account, regardless of the nominal legal structure above it. Day 6, the European Union's mandatory disclosure regime for cross-border tax arrangements compounds this. Intermediaries who structure, market, or implement arrangements bearing specified hallmarks are required to report those arrangements to their national tax authority within 30 days. Nominee structures frequently trigger Category D1 hallmarks, which cover arrangements that undermine reporting obligations, and Category E hallmarks, which target arrangements involving non-transparent chains of legal entities. The institutional alternative is a properly constituted foundation, a Liechtenstein Stiftung, a Panama Private Interest Foundation, or a DFC-registered foundation, provides genuine separation of legal and beneficial title. The Foundation Council, not the principal, holds legal ownership. The principal's rights are defined by the Foundation Charter, a governed documented instrument that specifies distribution rules, succession provisions, and protector mechanisms. This structure produces a defensible response to CRS information exchange requests. The Foundation is the legal owner, and its governance documentation demonstrates that it is not a mere nominee arrangement. The cost differential between a nominee structure and a foundation is real. Setup costs for a properly constituted foundation run between $15,000 and $40,000. Annual maintenance, council fees, compliance documentation, regulatory filings adds $5,000 to $15,000 per year against the cost of a successful beneficial ownership challenge in a high-tax home jurisdiction. These numbers are not a meaningful consideration. The final dimension of platform comparison is one that most principals underweight because it is not quantifiable in the same way as tax rates or treaty coverage, legislative stability. A holding platform is not a short-term arrangement. Principals who build these structures typically intend them to operate across a 10 to 20-year horizon, encompassing multiple business cycles, potential asset realizations, and succession events. The legislative environment in which the structure was built must be expected to remain materially stable across that horizon for the structure to deliver its intended utility. The UAE's federal constitutional framework provides a sovereign guarantee layer, Federal Decree Law number 47 of 2022. The foundational corporate tax legislation was enacted through a formal legislative process and would require an equivalent process to materially amend. The DFC and ADGM, the UAE's two primary common law financial centers, operate under independent regulatory frameworks with their own judicial systems. The Emirates of Dubai and the federal government have a documented and publicly stated interest in maintaining their position as a global financial services hub. The legislative trajectory is expansion and treaty accretion, not contraction. Hong Kong's position is more complex. The basic law, which provides the constitutional framework for Hong Kong's one country, two systems arrangement, has been subject to National People's Congress Standing Committee interpretation on multiple occasions since 1997. The National Security Law enacted in 2020 and its subsequent judicial application have introduced a degree of administrative unpredictability that did not exist in the pre-2019 environment. Inland Revenue Ordinance itself remains technically robust. The 2026 amendments are substantive and professionally drafted, but the legislative environment within which it sits is less certain than it was a decade ago. For principals with a long holding horizon and assets that will not be realized for a decade or more, this legislative risk differential is a material input into platform selection. It does not make Hong Kong an unsuitable jurisdiction for principals with genuine China exposure and APAC capital flows. It may well be the optimal choice despite the administrative risk. But it must be priced into the decision, not dismissed. What this episode has demonstrated is that platform selection UAE Free Zone or Hong Kong territorial is not a tax rate exercise. It is a structural exercise that must integrate treaty network geometry, substance credibility requirements, entity architecture, beneficial ownership governance, Pillar 2 exposure analysis, and legislative risk horizon. Principals who approach this decision with a rate comparison and a visa application are building on an incomplete foundation. The structure must be designed to withstand BEPS Action 5 scrutiny, DAX 6 reporting obligations, CRS automatic exchange, and a decade of enforcement evolution that the OECD has explicitly stated is still in progress. The inbound platform is not the end of your planning, it is the beginning of your architecture. Ultimately, platform selection between a UAE Free Zone and a Hong Kong territorial model is not an exercise in tax rate optimization. It is a rigorous structural calculation that must harmonize treaty network geometry, substance credibility, entity architecture, and beneficial ownership governance against a decade of evolving OECD enforcement. The structure you build today must be capable of surviving BEPS Action 5 scrutiny, DAX 6 reporting, and the permanent recalibration represented by Pillar 2. An inbound platform is not the terminal point of your planning. It is the essential beginning of your sovereign architecture. However, capturing the inbound value is only half the equation. You remain tethered to the fiscal risks of your country of origin. The final defensive layer is your exit architecture, the technical process of severing legacy tax ties without triggering a sovereign tax claim. In our next episode, we pivot to the Cyprus exit bridge, where we will detail the specific EU-aligned mechanisms required to transition wealth out of high-tax jurisdictions and into a neutral framework. This transition is where the most significant capital losses are incurred, and it is the subject of our next briefing. Join our community of informed investors to stay ahead. This data is for education and is not financial advice. Always consult a professional before investing. To speak with one of our specialists, click the link in the description. I'll see you in the next report.